So good morning everyone and welcome to Prime's Your Super and Investment Market Update. My name is Simon Matter and I'm the Managing Director and CEO of Prime, and I also lead the Wealth Management Division as well. So it's my pleasure today to be your host. We've got a number of other panelists and key speakers that will be going through various pieces of information around investment markets, our current view, what we think is going to take place over the near term, how we're positioning portfolios. And look, there's been lots of interesting news out even at the start of this week, which Jonathan Bayes, our Chief Investment Officer, will speak to. But some of our other panelists today are Olivia Long. Olivia heads up our SMSF division, and she'll be answering any questions as it relates to SMSF. And we also have Cameron Morcher, who is an investment committee member and also a partner in our wealth management division. So we've got plenty of people here to answer any of the questions you've got. Please don't hesitate. We've already had a couple of questions be logged. So let's make sure that we get a chance to answer those questions for you at the end. But again, look, I just really wanted to probably take the opportunity to thank all of our clients. I think we could have up to 100 participants today in this particular session. We've been running these sessions for not only SMSF and investment markets, but also for business owners as well. We think it's a great way to continue to communicate with our clients. And look, we understand completely at the moment that anxiety is reasonably high. You know, the environment is very, very fluid, and we're absolutely doing everything we can to try to be as proactive as possible with you as we're helping you to manage your positions and your portfolios. So during the GFC, we rolled out our weekly market update, which continues today. And this is an evolution of that process, whereby we create a forum to answer questions, deliver information to a number of people in as personalised way as we can. And so today is a continuation of that. We want to keep this going on a fortnightly basis, and we really look forward to your participation. So we hope that you're getting a lot of value out of these sessions. And we do thank you for being our clients, and we do know how important it is, the job that we're trying to do to assist you to protect your current positions. I did also want to highlight that you know, in terms of the Prime team, we're very proud of how our team have been operating. In the last 4 to 5 weeks, the whole team have been operating out of the office like much of the country has been as well, obviously. And we're just really pleased how, between a combination of how our clients have reacted to the video conferencing and the phone calls, etc., and the way our team has adapted, it's just allowed us to be on the front foot. So really proud of our team and thankful that you know, everyone is healthy and well and safe, as we hope that you are and your families are as well. So anyway, look, enough from me. I want to actually hand over to our key speaker today, Jonathan Bayes, who's been with the firm for over 5 years. Jonathan will lead us through a conversation on investment markets, and again, I'm sure he'll give us lots of information that will be relevant to your portfolio. Again, ask whatever questions you would like towards the end of the session as well. So I'll hand over to you at this point now, Jonathan Bayes, our Chief Investment Officer.
Thanks, Simon. Good morning, everyone. Thanks for lending us your 45 minutes, or I can be a bit wordy, maybe an hour with questions. But I'll hopefully scan through as quick as I can. I'm just going to share the screen with the presentation now. Again, any questions, please just type them in, and we will answer them at the end between Cam, Mark, Simon, Olivia, or myself. Let me just make sure that you can see that presentation. Okay. Okay, there you go. So a bit of a summary on the economy, markets, and portfolios in general. Again, just the usual disclaimer that we do. This is general advice only, but hopefully you're all aware of that. That is a disclaimer, and onward we go. So you know, we've had a pretty amazing bounce back in share markets, despite obviously a huge amount of doom and gloom on the economy. In the past month or 6 weeks, as Simon alluded, you know, maybe some of you guys have even attended 1 or 2 of these presentations. We've done about 5 or 6 summaries, you know, broadly speaking, one a week. And initially we focused a lot on the virus and its impact, but I think that now we can move on to the broader economy, which is what this presentation will largely focus on. We've had a really kind of cautious view that the impact on the economy would likely hold markets back, and to be really honest, it's probably been too cautious a view. The snapback in the last 6 weeks has been incredibly aggressive. I don't think it will continue in the near term, and so we're trying to take advantage of this bounce by clearing out some dead wood in the portfolios. But broadly speaking, we think there's a consolidation to come in markets, probably more softness than strength in the next few months as reality bites. So where to from here, as the chart implies? Just a slow reopening of economies, households and corporates into self-preservation mode. We've seen the statistics on the number of jobless in both this country and also in the States. So, 26 million new sign-ons for the dollar in the US in the last 5 weeks. Broadly speaking, about 700,000 people displaced from work here in Australia. And on top of that, those that are keeping their jobs, in many respects are seeing haircuts to their salaries. So a big uptick in employment capacity around the world, which means that we're going to see wages struggle in the near term. Also too, when you get big economic shocks like the one that we've seen, as a general rule, that self-preservation mode kicks in. And even if you've got cash flow coming in, you tend to save it for that rainy day. So I do think we're going to see some time before we see a significant economic rebound. The thing that we'll keep coming back to in this presentation, and indeed in our thoughts, probably I'd say for the next 3 to 6 months at least, is that consistently I think there'll be a focus on resilience, and that means that in the past decade, but particularly in the past few years, there's been a big focus on efficiencies and getting the most you possibly can out of your business or indeed your cash flows. Debt is extremely cheap, and so we've been encouraged by low interest rates to take on as much debt as we possibly can and to leverage up corporate and household balance sheets. And I think that in the current period of time, we will see that unwind, and that businesses and households, as I say, in self-preservation mode, will focus on resilience more. And that means that we'll see a weakening in consumer demand as we up savings rates. A return on equity for companies will fall because they will hold less debt or they'll pay down debt. We'll see also from a resilience standpoint a focus on health and safety at workplaces, clearly, until we get a vaccine, which is going to necessitate higher costs. And so I think that will be the theme of the day that we will continue to address over the next, I think, at least 3 to 6 months. The rebound back in markets has, as I say, surprised us to the extent that it has. And so we now have equity markets back at the high valuations they were at pre the sell-off, when taking into account the earnings downgrades. And those valuations were 20-year highs. So it's rather incongruous that we've got equity markets back at 20-year valuation highs when we're facing the biggest economic depression since the 1920s. The one thing that I would really highlight here is that people really are feeling around in the dark, both from an investment standpoint and from a corporate business standpoint, because it's been so immediate. This has happened within the last 6 weeks. And as you're now starting to see with corporate earnings reports that are coming out in the US and Europe in particular this last week, they're reporting on the March quarter. They only saw an impact really kicking in the United States, at least, in those last 3 weeks of the quarter. So it's very difficult for them to give much of a guide on outlook when the impact has been so immediate, and frankly speaking, we don't know how long it's going to last for, and really how readily we'll be able to get the economy operating again, even at a limited capacity, until such time as we get a vaccine. And the vaccine is really kind of key. And if I give you one modest amount of optimism on it, and this is really just something in the last 24 hours, again, there's a lot of speculation on virtually everything to do with this virus because it is so new, but I was encouraged to see some comments from Anthony Fauci, who has been the virus sort of czar, if you will, in the United States overnight, saying that in the early trials that are currently being conducted at the moment, that he was encouraged to see that they were gleaning an autoimmune response in the monkeys that they were testing it on, which by no means indicates that it's going to be worthwhile for humans. But for a man who's deliberately played a pretty straight bat over the last few months, you know, I did take some heart from seeing that. Either way, the likelihood of mass manufacturing and distribution of vaccines is at least a 2021, early 2021 thing. So we've got some time away from that. I won't dwell on every chart for that longer period of time, guys, I promise. So yesterday we had, or the day before, we had National Australia Bank report their interim profit numbers, but at that point in time, they announced a $3.5 billion raising. And within the information pack, they outlined what they were thinking in terms of their economic outlook. And I thought, to be honest, given it's as uncertain as it is, that this is quite a timely sort of description for what they, as one of the biggest banks in the country, are seeing in that bottom left-hand chart, and also what they're expecting in the top right and bottom right charts. So you can see there, and again, this presentation is available to all of everybody post me finishing talking. But as you can see there, you can see the drop away year on year in spending across a variety of sectors. It's been really pretty significant. And the way they foresee us rebounding is that it takes us a good 18 months to get back to pre-COVID-19 levels. They're talking about 2022, a peak in unemployment sometime around the mid part of this year in the 11 to 12% range, and then a slow grind back higher. But I'll level with you. I think that they are feeling around in the dark in the same way that everybody else is at the moment. But that gives us a rough idea. I would say that the longer that it takes for a vaccine to be developed, or in the very near term for contact tracing, to provide a good assessment of on-the-ground rates of infection, the longer it takes, the slower the rebound will be, because it starts to infect the consumer psyche. But it's, you know, again, pretty tricky 6 months or so to come. And then the next charts are going to demonstrate that to you. So here's the Westpac Australian leading indicator. This was released last week for the month of March. Just shows you context there. This is the early economic data, and that which tends to foreshadow the economic outlook on a 3 to 6 month forward view. And you can see there that it's as bad as it's been in 20 years. You know, consumer confidence also released last week and also compiled by Westpac, you know, virtually at the lows that we saw back in late 2008, early 2009 here in Australia. Business confidence numbers as well on the left-hand side. Capital expenditure intentions have collapsed, and broad brush business confidence figures on the right also have collapsed, and again, notably, below the levels they got to in 2008. And I'll come to why I think it's going to be different for our economy than 2008 at the end. But the simple remark would be that we're lacking a lot of the levers that we could pull back in 2009 to re-stimulate the economy this time around. Australian Industry Group data is something that we focus a lot on because it tends to be quite timely. Comes out very early in the month. We've had services, construction and machinery sector numbers. On the left-hand side there, you've got the services index new order figure. The way to read these charts, guys, is that 50 is break even month on month. So below 50 means that it's the data is down on the previous month, and the further below 50, the more significant, and the further above 50, the more significant. And so you can see there that new order numbers in the service sector, which is about 80–85% of the economy, have collapsed back. And similarly, sales figures within the service sector have also taken a big impact. And, you know, nobody should be surprised to have seen that. In terms of the construction sector, it's already been very, very weak this last 12 or 18 months, as most of you would be aware. And we're now at a 6 or 7 year low. And I think, unfortunately, the construction sector is going to be quite negatively impacted over the coming 12 to 18 months from the perspective of confidence. I think we're going to have a rerun of the 2018 house price correction in the coming 12 months as individuals and corporates try to pay down debt and raise cash where they can, and that will have a bearing, I think, on house prices, as indeed I think it'll have an impact on excuse me, on most asset prices. The one sector, encouragingly, that's done well in Australia is the manufacturing sector, and that's been on account of broken supply chains internationally and the need to have to fill orders domestically. But we also have a reasonably substantial domestic food manufacturing business, which has benefited, I think, by the surge in retail sales in the supermarkets. So manufacturing and transport have been the two industries to have done really quite well in the last month, as well as obviously online retail, which has been a big positive for the transport sector. But manufacturing, new orders on that chart, as you can see, have surged in the last month or so. Unfortunately, manufacturing is only about 7% or so of the Australian economy, but definitely a small bright spot. So my real concerns come from the impact on employment that we're going to see. And so this is skilled vacancy numbers on a month-on-month basis. Last month in March, down almost 5.5% on the previous month. But depending on which job vacancy index you look at, job vacancies are down between high teens and low 30% range. And they were really kind of soft going into the outbreak of COVID-19 anyway, as you can see that steepening chart in early 2020. The economy before we went into the coronavirus was already in a pretty busted up way. Advertising revenues in the first 2 months of the year were down 8% on the previous year. They've since collapsed further by a further 30% or thereabouts. But we were pretty soft going into the coronavirus outbreak, and unfortunately, that softness has been exacerbated. Wages. So on the left-hand side, we've got construction sector. So wages are still positive, but on a very significantly declining trend. I would expect at some point in the next couple of months they'll turn negative, and equally to the service sector, which has a huge role to play in employment terms, has collapsed hugely, but still marginally positive. But again, I think it's just a matter of time before we see those numbers fall into negative territory. And clearly, if wages are being cut, we're going to have a big material impact on consumer demand. There's a couple of charts here which I'll show you, which augur negatively for Australian wages. So this chart here, the white chart, is the sum total of Australians in the labour force, so of working age, able-bodied, and able to be employed. This is the number of people that are unemployed or underemployed. And you can see on the right-hand side, it's about 13.7% of the labour force. And you can see that I've inverted that chart so that it sits quite nicely against the red chart, which is Australian annual wage growth. And as we see an escalation in unemployment and underemployment in Australia, it's very likely that annual wage growth will dip below 2% and probably even get down to somewhere in the order of 0 to 1%, which is certainly not what we want to see as an economy. The other big issue around the world, but particularly here in Australia, particularly at a time when your domestic cash flows are suffering, is how you service your debt. Now, fortunately, with interest rates as low as they are, the impost on most monthly budgets is still quite low. But it becomes a problem if you lose your job, or indeed if your wages get cut. And you can see here, this is Australian household debt to income, how significantly that is escalated post the GFC. We've taken on more and more debt as interest rates have fallen. And as I say, that's perfectly fine when you've got a strong economy, but when you lose your job and you can't pay your debt, we have increasing issues. Around the world, debt has escalated. In Australia, the big issue is at a household level. In the United States, it's at a corporate level. And so you'll hear a lot of commentators, and including ourselves, focusing a lot on corporate bond markets as being a key leader of equity markets over the next 6 months. And in the case of Europe, the debt is held in large part at the sovereign level, at the nation state level. And so the big concerns there are the huge amount of debt that's being held by countries like Italy, but also to Spain and France, on top of the smaller countries which you've all heard about, being Greece and Portugal. What tends to happen in times like this, as I flagged before, that self-preservation mode kicks in and we up our savings rate. And this is the Aussie household savings rate. And you can see, despite the fact we didn't have a recession in 2008, savings rates doubled. And, you know, if you happen to have me back in 6 months' time talking about things, I'll happily bet that savings rates in Australia are well on the way to 8 to 10% by the end of the year. So that's to come. House prices. Again, we've had a rebound in the last 12 to 15 months. But unfortunately, I think we're set to roll over. There's been some, Louis Christopher does a great job of getting headlines, but there have been some pretty aggressive calls on house prices made, particularly by him in the last couple of weeks. He's saying they could be down 30%. I think that's probably a stretch. I think that's definitely a stretch. But I do think we're going to get a reversion in house prices, probably in the same manner that we saw back in 2018. Where house prices came off in the order of 10 to 15% on a year-on-year basis. The chart here just reflects auction clearance rates, which is the chart in the red. And you can see there that in the last couple of weeks, we've seen the lowest weekly auction clearance rate figures that we've seen in the last decade, even lower than we got back in 2018 post the Royal Commission when credit started to tighten up. And auction clearance rates, unsurprisingly, lead house prices because they're a pretty good guide on demand and supply. And so if auctions aren't clearing, indicates obviously that there's less buyers than there are sellers, and you know, the rest of the chart I think is pretty self-explanatory. We should see that white line roll over again in the way that it did in 2017-18, and house prices ultimately come off their what is almost now back at their peak by about 10 to 15%. So concerningly, you have to look at markets and economies and say, well, what stimulates us back into growth again? And in Australia, we don't have the levers to pull on that we had back in 2009. And let's remember, we didn't have a recession in 2009. And the reason being was that we had all of these levers to pull, whether it be the fall in interest rates that you can see in the top line, whether it be government stimulus, which obviously we had a huge amount in the war chest there that we could pull on. We're now not in that position. You know, again, it's quite amazing. We've seen over $20 billion of cash in the bank as a country to you know, $600 billion in debt in 12 months' time. Again, at a household level, we've taken on a huge amount of additional debt. And equally to the Australian dollar is now in the 64, 65 cent range, where, you know, it was 90 cents in 2007 and actually popped its head above parity against the US dollar in early 2011. So that provided a lot of stimulus to what was a pretty soft economy for the last couple of years. So we don't have those levers to pull on. And it means that we're, I think, highly likely to experience a period over the next 6 to 12 months of soft demand as households and business try to repair balance sheets, and as a result, less than they have done in the past couple of years. So again, self-preservation seems to be a term I'm using a lot of. In terms of the rest of the world, you know, China unsurprisingly went into it first and has come out of it first. It's hard to sort of get a real guide on the Chinese economy from their economic data because it does tend to get massaged. It's a polite way of putting it. But a couple of data points that are hard to manipulate tend to be railroad traffic and electricity as a general rule. Bank loans are another one. This is just Chinese electricity output. Can't store electricity largely. So it gives a pretty good idea for industrial activity, down 4.5% annualized in March. But things are starting to turn around in April, which is good. Again, when you run a command economy the way that they do in China, you can pretty much order people back to work, and that's basically what's happening at the moment. This chart shows small business confidence in China, which obviously, like the rest of the world, fell off a cliff back in February, a little bit sooner than the rest of the world, I should say, but has rebounded back again above 50, so that's positive month-on-month growth. What seems to be occurring in China is that everyone's been largely ordered back to work, but on the weekends, activity is far less. So this is actually a week out of date. I apologise, but I did quickly glance at the past weekend's data, and it's not majorly different. There's a behavioural shift that's occurred and will likely be reflected elsewhere in the world, and this is just on how residents in Beijing, this chart particularly, you can see especially there on the major city in the world, if you go to tomtom.com, this is just traffic data, and it compares the traffic congestion on each day in the last week with that of the previous year. The red line is this year, and the dotted line is last year. And so you can see there that during the week, congestion is pretty much back to the levels it was at in 2019, but on the weekends, it's significantly less. So again, there's a distrust, if you will, or a reticence to go out in public on the weekends, but during the week, people have been told to go back to work, they're back at work, but on the weekends where they're perhaps not obligated to do things, they're not. Anecdotally, I've also heard that the government's putting money in people's Alipay accounts, but that the money can only be spent physically in store. Like governments around the world, there is a huge push to get things back to normal as best as they possibly can. Then you get to the US, and I've left Europe alone because they're going to be the slowest to come out of this, but probably less relevant than the US as well. This is consumer confidence in the US. And the next couple of charts I'm going to show you just show you that there's a very different attitude in the United States to the coronavirus, and it's one of optimism. So yes, consumer confidence in the last month or two has rolled back. Unlike the charts you remember from that I showed you from Australia right at the start, or two charts ago from China, you can see that where those charts plumbed to record lows, consumer confidence in the United States isn't even close to record lows. In fact, it's only back to the levels that it was at before the 2016 presidential election. So yes, there's been a sting in the tail for the virus in the United States, but there is still a very healthy optimism that the economy will come out of this in quick succession. And these two charts, I think, demonstrate that the best. On the left-hand side, you've got the Philadelphia Fed business outlook numbers. There's a whole heap of Federal Reserve branches around the United States, branches of the Federal Reserve Bank that all conduct surveys in their economic regions. And Philly tends to be one that some people look at. It's quite a large industrial economy on the East Coast. So their business outlook figures there plumbed to new lows in terms of the here and now, but encouragingly on the right-hand side, or encouragingly or naively, depends on how things play out in the next few months, I suppose. But on the right-hand side, you can see the 6-month forward outlook is very much unchanged. There is a huge belief, rightly or wrongly, that the coronavirus will be contained and that the economy will be only very moderately impacted. And that might explain part of the reason why, I won't go into all the reasons because there's a variety of them, but it certainly to some extent explains some of the optimism that's come back in the share market over the last 6 days. And this is all despite the fact that boatloads of Americans are sadly out of work or losing their hours. And this is about 3 weeks old, this survey now, but it still makes the point that the economic impact on households in the United States is enormous. The bottom couple of bar charts I think are most relevant, and you can see under 45-year-olds, 60% of those surveyed have either lost their jobs, been put on leave, or had their hours reduced, or expecting their hours to be reduced. It's quite incredible. The US labour force is about 160 million workers, give or take. And in the space of the last 5 weeks, they've lost 25 million, or 25 million of those workers have applied for the dole. So, you know, virtually speaking, 15% of the workforce. It's quite incredible. So it perhaps speaks to the desire on behalf of many of the governors and the president to get the economy going. And indeed, that's a global thing. You know, it makes you know, we all want people back at work as quick as possible. So this is again a quote that a former colleague of mine made that I really keep coming back to over and over again, because I just think it really sums up the world that we're living in at the moment, and that's one of resilience rather than efficiency. And so he's an ex-banks analyst and probably one of the best going around. And so he had an interesting perspective that, you know, broadly speaking, corporates across all industries in the coming 12 months are going to feel the need to protect themselves in much the same way that the global banking system was forced to do so post the GFC. And if you recall back then, you know, we obviously had the financial crisis, which took its toll on the global economy. And at that point in time, regulators said, listen, we can't have this happening again. We can't have the banks in a position where they can't provide liquidity to the economy when it's needed, because they've taken on too many losses themselves, and they're inadequately capitalized. And so for the last 10 years, regulators around the world have been forcing banks to hold a far greater amount of equity as protection against crises like the one which we're currently experiencing. But as everybody knows, if you run a business, if you hold more equity, you know, it dilutes your ultimate return. And so the banks, you know, were previously holding Tier 1 capital in the order of 7 or 8%. Here in Australia, they've been forced to up that to 11.5% or more. And as a result, returns have diminished. And his remark is that we're now going to see, I think, the same trend apply to balance sheets across the rest of the world. It's quite remarkable the amount of impact earnings on earnings per share for shareholders that buybacks in the United States have contributed over the last decade or so. So it's virtually 30%. Of all EPS growth over the last 15 years has come from companies leveraging their balance sheet up to buy back stock. On top of that, obviously, operational concerns from a health and safety standpoint. You know, again, I would imagine in many places that there'll be dual shifts running. There'll be high costs from a facilities maintenance standpoint to keep workplaces safe and clean. I think many businesses now, with the breakdown in global supply chains and the desire to control your own destiny in terms of your supply chain, will see that companies will forego high costs to have that certainty of supply. So they're the things that we mean when we talk about resilience. And so the second round effects from the coronavirus are other things that we need to consider when we're looking at portfolios, particularly over the next 6 to 12 months. And most of them relate to debt, but a lot of them potentially, with the US election coming up in November, could also come back to the disparity that's opened up in terms of the wealth gap between rich and poor. So, you know, savings rates we've talked about, you know, do we get a material impact on the consumer psyche? Well, I would say in Australia, definitely yes. It's out for debate in the United States as per those charts at the moment. We've got a ridiculously high amount of debt in countries all around the world. And so the obvious thing is to sort of say, well, how do we pay this back, and which part of the tax base gets impacted in terms of you know, having to do the heavy lifting to start to pay down some of the debt. You've clearly got the US and China escalating their disagreements, and that is not going away anytime soon. It was already there, even with the signing of the trade deal back in January. China effectively set out a decree in early January, telling companies that in the medium term they need to reduce as much of their exposure on US supply chain as possible from a technology standpoint, and so that is going to be a very long thematic for markets in the next few years. Emerging markets have got boatloads of debt, and again, really struggling, I think, under the weight of the current virus. Places like India and Brazil in particular, but Mexico increasingly in the last week, starting to see hospitals fill up. They're not doing nearly the amount of testing that's being done in the developed world, and again, we're probably still not doing enough testing in the United States, as an example. Oil demand has cratered, from the cessation of airline travel, but also too from the falling car trips. Oils are a very large part of the US corporate bond market, and so with oil at $13 or $14 a barrel, there is likely to be a wave of bankruptcies coming through, which has the potential to disrupt corporate bond returns, which in turn, as I say, might force for higher equity raisings, which will dilute equity market returns in the same way. And then, as I say, we come to the election in November, and who knows which way this will go. Frankly speaking, my one political remark, they're both two pretty disappointing candidates, if you ask me. But we've had a desperately pro-Wall Street agenda under the current president, which has really helped equity markets in particular, and indeed the US economy. And it would be disappointing, I think, to investment markets to see that changed. Putting aside any other political views you may or may not have from an equity market standpoint, it's definitely the case that investors will want Trump to win again in November. Encouragingly, and this is, I guess, a factor that's helped the market bounce back, where for the first time in a few years, you're now getting paid to take on risk. There is no doubt that the risk of investment has escalated quite significantly in the last 6 weeks, but returns are now compensating you for taking that risk. So this is just the spread of high yield returns against cash. And so you can see that, back up, we got for a day or two to about a spread of 10% when the markets bottomed in late March, and we're now at about 8%. But again, as per the previous chart, there's a rising risk of bankruptcies. So it's not a one-way street, but it's definitely better than it's been in some time, and that's the positive. Long-run equity valuations in the United States are not attractive. This is a long-term price-to-earnings ratio on the S&P, and you can see the quick bounce back. In fact, this is about 4 or 5 days old. It's actually a little bit higher now, but we are well above the 20-year average. And so it's hard to say that valuations in the United States are anything but expensive. Back to the point I made at the very start, where we're back at 20-year highs on current forecast earnings. These are the average over the last decade, but still expensive. In Australia, on the other hand, things are much more interesting. So briefly speaking, we got down to levels near enough to that which we got in the GFC, around 12 times, 11.5, 12 times. We're currently about 15 times, but we are below the medium-term average. But then equally, and encouragingly, that average is struck against a pretty soft economy, really, in the last decade here in Australia, from an output standpoint. So our expectations are far less aggressive. However, I think that the outlook for our economy in the near term, because of household debt, is also a bit troubled. So again, it's we're certainly more attractively valued than the United States, but our economy perhaps has a few more hairs on it in the very near term. And just rounding out, guys, because I know I've spoken for 40 minutes or so. What are we doing? So we remain defensive. We think, again, it's a very uncertain market at the moment. We've got larger cash positions than we've had in some time. And in fact, we've been pretty conservative, as you all recall, for the last 18 months anyway. We think that certainly in the domestic Australian equity positions, we're positioning ourselves for a pretty soft period of growth, pretty low returns. Unfortunately, the one part of the portfolio that perhaps has underperformed in all of this has been the Aussie equity portfolio, which is disappointing. We actually had too high an exposure to small and mid caps at the start of the year. We were hoping for an improving economy here domestically, the prospect of tax cuts coming through at the May budget, and obviously that view was upended with the virus coming through. And so what we've been forced to do in the past couple of weeks with this bounce is that we've been selling out some of the exposures, some at a loss, to try to improve our exposure to more defensive earning streams, certainty, and we're sort of hunkering down in that part of the portfolio for probably what will be the better part of 2020. So there's been a lot of changes coming through, and we're pretty hopeful we'll get back that underperformance in the next few months. Elsewhere in the portfolio, it's been pretty good. International exposure, which we've been advocating for a long time, has been very good. We've started to mitigate a little bit of the Australian dollar call that has helped returns on the international equity side. We moved one of the funds into a hedged version. We could change that potentially going forward, but that's just again a risk mitigation strategy. And another one of the calls that has been good for us, but we might need to start addressing soon. And I would say, before I say this, this is a defensive move, not an offensive move, but that would be to start reducing the underweight in Australian banks that we've had for a long period of time. The banks are now back at levels that we saw in 2008 or thereabouts in terms of the relative performance of the Aussie banking sector against the market. Banks are now trading at a discount to book value, which doesn't need to mean anything if you don't take into account the returns forecast. But broadly speaking, that's starting to get a little bit cheap against the returns that analysts are forecasting. The trouble you've got, obviously, is that banks can, like any other stocks, can be cheap, but cheap isn't just the sole ticket to a rising share price. So we do have a major underweight there. We're probably going to see dividends skipped from ANZ and Westpac next week, albeit NAB paid a very small amount out in their half year early in the week. But we're getting to within the last 10 to 15% on the banks where it might be appropriate to start upgrading our positions. The one big thing that we continue to advocate for that just looks like a tremendous opportunity in the medium term are these property debt exposures. So again, in the recommended portfolios, we've got Qualitas and we've got Metrics. And for those of you that are able to invest at a wholesale manner, there's a few other funds that we recommend. But in talking to the guys that run these property lending businesses in the space of the last 2 to 3 weeks, with the pressure on cash flows being felt by developers and the like, the rates that they've been able to charge on first mortgages have blown out from what was quite tight at 8%, are out now at 11 and 12%. And the terms that they're lending on have seen loan-to-value ratios fall from the mid-60s to the low 50s, so a lot more defensive. So it really feels like, in a zero interest rate world, that this is one part of the market that over time, I think is going to provide some really good income for portfolios, certainly over the next 12 to 18 months. Anyway, that's me done. So I might hand over to you now, Liv. I'll stop the sharing. I'll leave it and hand over to you.
Flip to the next slide. Thank you very much. Good morning, everybody. Can you just flick the slide, please, Jono?
Yep.
Cool. Okay, so by now, most of you would have heard about the $10,000 early access or early access relief from superannuation funds. That has been a very successful call by the government. Over 800,000 people have already accessed it. And to do so, for those of you, a few things to consider if you don't have the cash available to do it, is that it's not really an ideal time to be selling down assets to access that money. So we're encouraging people, if you don't need it, if you don't really need it, try not to use it. But to access it for both super and SMSF, you just jump online to MyGov. The online forms are now available, and generally you will get a response within 3 to 4 days. People would have heard by now that pension minimums have been halved, not just for the 1920 year, but the 2021 year. The question everybody is asking is, can we put the excess that we've already drawn back in? And the answer is that you cannot, unless you are eligible to make contributions to your fund. So speak to your advisors about that if you've got excess money and you would like to try and get that back into your super environment. The government have very cleverly announced rent relief for related party transactions. So quite simply, where an SMSF is leasing a property to a business or a property to themselves, it is acceptable to have a period where you do not pay rent throughout these times. So again, that's an area that we encourage you to speak to us about if you do have related party transactions. There are maybe benefits associated for some people with stopping and restarting pensions at this point in time. Obviously, portfolio values have decreased significantly from when many people may have established their pension. A stop and a restart can decrease that pension cap. So again, an area that you really should be seeking advice on at this point in time. Death benefit nominations, without being too morbid, continue to be a really important item. A lot of people don't either have them on file or don't realise that their super is not automatically dealt with as part of their will. So make sure that your death benefit nominations are actually up to date. And then finally, everyone should have a will. If you don't, speak to Prime, we can help you with that, but definitely get your affairs in order. It's prudent to have one at any point in time, not just now. So that's pretty all I've got on the super front.
Great, thanks Olivia, much appreciated, and thank you Jono as well. We will now welcome back Cameron, and Mark's also on the line as well if anyone wants to ask Mark questions. So look, I think what we'll do is we'll just start with the first question that was emailed through actually before we started today, and that was from Janet Lafferty, and I think this one's really for yourself, Olivia, and we always appreciate a bit of time to get a heads up on some questions. But Janet's asked, will the government be extending the age limit for super contributions?
Yeah.
So over to you, Liv.
So basically, at present, there's legislation before Parliament to remove the work test for people aged 65 and 66 to be able to contribute into the super. So that's one positive. But we've had a lot of feedback from people who are aged over 75 and who are still working and who do want to contribute to super. So we've got our SMSF Association lobbying the government. I've had individuals ask me for Josh Fredenberg's email address, and I thoroughly recommend the more people that campaign, the more people that lobby and ask the question, the better the chance of it happening. But at this stage, there's been no talk of it anywhere. Okay, thank you, Olivia. So there's no other questions that are currently online, but just a couple of other quick ones that I might actually pose to yourself, Jono. Just has there been a key piece of data or something that's occurred, since this crisis began that's kind of surprised you on the most likely on the negative, or what's kind of been one of the key things you've kind of gone, wow, that's just kind of knocked me off my feet. I wasn't expecting that.
To be honest, it's hard to think of anything straight away because, I mean, the data, even the stuff that, well, I'll take a step back. We're only now getting the April data starting to emerge this week. It's the 29th of April. So, we're only going to get manufacturing data out on Thursday and Friday in China and the US for April, and also too for us here on Thursday. And April's really the month where the rubber sort of hit the road in terms of the impact globally. So that will be key. I think the jobless claims numbers, we've talked a lot about in the last 4 to 6 weeks. So that's probably, now I'm thinking on my feet, that's probably one, 25 million jobs is just quite incredible. The suggestion in California, given that there's such a huge exposure to the ports there and independent contractors and what have you, there's some suggestion that even half well, it's pretty much along the lines of the survey I showed, half the workforce in California have been impacted in some way, shape or form, which is, kind of incredible. But the next couple of months will be really key. How quick can countries like Italy and Spain get back to work? I mean, the UK are still in lockdown, for another 3 weeks, I think. How successful or not will the US be in opening up parts of their economy over the next couple of months? And will they be forced to shut it back down again in the way that Singapore were? So there's just, back to that point, we're feeling around in the dark at the moment.
Yep. And great to provide a response there, John. We've just had a couple of other questions that have come through. William Prentice has posed a question, but I actually don't have that in front of me now. But so I'll skip that one for the moment. But Mitch Sargent has asked, with regard to global diversification, do I understand that you feel the USA may still have further to fall potentially? Europe is set for the slowest recovery, but Australia looks to be in the best position for a return to the norm.
Yeah, I think that's a good assessment. I think it keeps coming back to Trump, but in the same way he's run his businesses for the better part of 40 years, 50 years, he's a roll the dice kind of guy, and that is very much the way it is in the US, and that's the way it seems to be going with the reopening, the whole treatment of the virus and their ability to try and skate through without filling hospitals up in the way that they saw in New York. And if they're successful on that front, with all of the liquidity that is being printed by the US Central Bank, then maybe it justifies this optimism. I'm a glass half empty guy, as everybody on this video conference can attest. So I sort of struggle to see how that plays out, short of a vaccine being developed, with everything I've read. The problem in Australia is that we're going to do a terrific job in curtailing the virus in the same way that the Kiwis have, and we will probably get back to work, sooner and with less fear from a personal standpoint. But we've got a boatload of debt, and the Aussie economy can't exist in isolation without the rest of the world. So, even if we come out the other side faster and quicker, we kind of really need China and the US to rebound strongly. Otherwise, we'll struggle to get out of second gear. But diversity from our standpoint, just to be really clear, isn't about necessarily comparing one against the other. It's the reason we've been so overweight international equities, and arguably it's not going to change for some time, is because you just get a much better exposure to the global economy than you do locally. We've got a very narrow market, as we've discussed before. We don't have a huge amount of technology. The banks have dominated things, and so fortunately, we've had a negative view on the currency, which is really, souped up returns. But even without a negative view on the currency, we can hedge part of that out. We're just going to get better exposure to global economic themes than you're going to get in the local market. So even with a slightly more positive view on the currency, we're still very big advocates for international equity exposure. It's just that maybe we want to be doing it in a hedged fashion.
Okay, thanks, John. And just a quick follow-up question from Mitch was, Asian developing nations looking stable or too hard to analyse at this point?
No. I mean, they've done a terrific job. Certainly in Taiwan and Korea. Japan a little bit less so. They're now going through their own issues. but again, Korea and Taiwan are very, very large export economies and hugely dependent upon the US consumer and on both the Chinese consumer and Chinese corporates. So, again, Korean exports to China, which is an indicator everybody follows because it's out really early in each month. They stabilized last month, but the first 20 days of April, they're down 27% year on year. So, we can all talk about China going back to work, but they're not really going back to work they're building stuff, but there's no demand for it at the moment because the rest of the world's in lockdown. And all these things have knock-on effects to Korean shipbuilders, Korean automakers, semiconductor companies. In the case of Taiwan, it's much more tech-oriented. They've done a terrific job, but if the end demand isn't there, then that even these really well-handled economies will struggle.
Yeah. Thanks, John. And we've been able to get the question now from William Prentice, and thanks, William, for reposting that. But the key gist of this is there's lots of capital raisings taking place, whether it be through institutional placements or share purchase plans or whatever else it might be, and the government allowing super withdrawals. Will this be a drag on markets, i.e. lots of available cash taken from investors and super funds?
Absolutely, 100%. So back to that point, the key thing that we'll be talking about is this point of resilience and lower return on equity. And every time you raise equity, you dilute existing shareholders. So completely and utterly, it'll be a drag. That said, $12 billion worth of raisings isn't enormous in the overall scheme of things, but it will be ongoing. There'll be more companies. The longer this drags out, the more companies will need to raise. We've sold a couple of companies that disappointingly have fallen below where we bought them in the last couple of weeks. We've sold out of them because the economy is not going to be what we thought it was going to be, and that they're holding more debt than we think can sustain in a softer economic environment. So you're absolutely spot on, and there'll be more to come.
Thanks, John. And probably Cam, just to bring you in here at this point, just when you're talking to clients and have you seen a major difference between what's taking place now versus, say, other market dislocations? Has there been a change in the style of conversation you're having with clients or approach? Obviously, the portfolios that we've got today are vastly different in terms of the way that we're positioned it with more international and various other things. But can you just give a little bit of context around that?
Yeah, so I think this time around it has been a lot quicker than other dislocations. So it's been a really constructive conversation with clients about staying the duration of the journey and not getting panicked into selling out of things that have really come down very quickly in the last 4, 5, 6 weeks. I think we have done a really good job in protecting some of the downside going into overweight positions in the alternatives area and unlisted property and the like, and a really healthy, internationally diversified growth exposure as well as the defensive. So I think the thing that is different this time around, that people are seeing the other side of this. So there's a lot of uncertainty out there. We're certainly in the camp that it is going to take a little longer to recover than the market may be expecting at this stage, but it does seem that we can see 12, 18 months out that the economy is going to get back to maybe not where it was, but fairly close to it. So I think that's really helping people stay patient and stay in the course. I think the other big difference that we are seeing this time around is that income has really come down materially, and we are not really expecting the income to bounce back maybe as quickly as it has done in prior occasions. The cash rate here is 0.25% and unlikely to move realistically for quite some time. And so that provides the anchor for lots of the defensive investments that are paying a margin over that very, very low rate. So we are very aware of the need of clients, particularly in pension mode, to be generating a large amount of income and hopefully meeting their cash flow requirements. But we also do have quite a defensive portfolio set up that we're not going to be forced into selling shares at low prices to supplement lower income levels. We do have overweight cash positions, and we do have quite a few defensives in there that over time we might start rotating more into growth assets when the market de-risks, and that should improve income levels over time.
Yep, great response, Cam, and good context. So And probably just worthwhile noting for those of our clients who are online at the moment that a recommendation has gone out overnight, and one of the messages that the investment committee has been very resolute in has been that there's no rush. Because we have been defensive, there's been no rush to jump back in. Obviously, there's been a reasonably strong bounce from the lows, but we have put a recommendation out over the course of the last 24 hours to clients, by recommendation, and the discussions around Coles on that front there. So for the clients that are here on this call, we'd probably just encourage you to try to action those final, for the moment, sells that we've got in terms of the repositioning of the portfolio. And we look very favourably on the Coles position. But before we talk any more about that side of things, William had finally popped in another quick question, which is, some shares like CSL, R&D remain strong, others have been savage like the banks. Do you think better and better returns in the next year or so will come from the savage, well-managed stocks compared to stocks like CSL and R&D?
Yeah. So in the next, it's hard to say. In the next 3 to 6 months, I think it'll be, and I feel like I'm hedging my bets when I say this, William, so I apologise. I think there'll be a broadly similar degree of return. The CSL's, ResMeds, Cochlears of this world have been fantastic because they benefited obviously from very strong secular growth trends, not impacted by the economic slowdown, maybe Cochlear aside, but also benefiting from the softness in the currency. CSL at an operational level has done an incredibly good job in terms of growing their volumes relative to the peer group. So totally deserves to have outperformed, and really, one of my great regrets is missing buying it on 2 separate occasions. But the valuations on these things are incredibly high now. And if the currency starts to tick a little higher, as I suspect it's starting to do, we'll start to lose a little bit of the impetus in these stocks. But my hope is that they will give back some of the valuation premium that they've achieved, whilst at the same time too, the banks, as you bring up, have been beaten to a pulp. There's not a great story in the banks, but they are now starting to look a little cheap. And so I would imagine that things will normalise a little bit in the near term. Everybody's very overweight those healthcare names, very underweight the banks. And so I think that the obvious outperformance of one against the other will diminish. It's hard for me to say on anything other than a 6-month view what will occur. I would love to have CSL in the portfolio. As I say, it's a black mark on that portfolio for me, and I need to, particularly now that it's the largest company in the country, we need to keep an eye on it. But it's just extremely expensive at this point in time, and it's very over-owned. And I think that we will get better opportunities to consider buying it in the next 6 months as I say, other parts of the market become a little bit more investable.
Fantastic. Thanks, John. And just before we finish up, probably just a reminder, as I said, the recommendations have been personalised and been sent out to clients over the course of the last 24 hours. But just given there is that buy recommendation there, Jono, for Coles, did you want to just make mention of, sort of some of the core thesis behind that?
Yeah.
We've got an audience.
Absolutely. So I mean, if you had have asked me 6 months ago, would you pay 20 times for a supermarket company? I probably would have said no, and I would have been wrong. We had a very good call in Woolworths 2 or 3 years ago, which we exited it too early, and Woolworths traded to 25 or 26 times. And again, I would never have imagined it happening, but it did. But Coles fits into a neat part of the market that we think will outperform in the next 6 months because it has some certainty to its cash flows. So Coles, Telstra, Amcor, which has been a recommendation that took a while to work but has actually been really good in this situation, is doing very well again today. New Farm, as we come out of the drought. NextDC is a company we've got a very close eye on. We want to put it into wider portfolios, which is a data center company. The theme in all of these things is that there is a degree of certainty to their cash flows, and there is a strength in the balance sheets that they all have, which means that we're not going to see dilutive equity raisings or significant leverage to profits from a decline in their revenue lines. Coles have reported their Q3 sales today. Stock actually, if you're looking to buy it today, is down 2.5%. So you're going to get the chance to buy it cheaper than yesterday. But it pays a 4% fully franked dividend yield. It doesn't have a huge amount of debt at all. They've got a big CapEx program the next couple of years that should take a significant amount of costs out of the business for them to compete with Woolworths. It trades on 21 times earnings. I think, to be honest, at $16, you know, we'll see that stock at 19 or 20 in the next 6 months or so. But even if it doesn't quite get to those levels, I think in a market that's probably got some risk to it, it'll hold its own and pay the dividend. And it's a good quality company that we think has got a good couple of years ahead of it. The companies that we've been selling out of have just been unfortunately hit by cyclicality. So there's a variety of companies, be it Boral or the oil companies a couple of weeks ago, or aged care, which was a real disappointment initially. But we really want to rip the Band-Aid off on these things, because whilst we've had a bit of a bounce back in markets, hasn't recouped all of the initial prices paid for them, but we have had a healthy bounce back in some of these things. That this is an opportunity for us to clear out the dead and to focus on a degree of certainty in cash flows that the likes of Coles and Telstra and Amcor will provide and have provided in the last couple of months.
Wonderful, thanks, John. And look, great summary. And look, there's no other questions here from attendees. So I'll take this opportunity to thank all of our clients for attending. We really appreciate you taking the time. As Tiffany, who works in our marketing team, will circulate the recording of this particular session, should you want to share that with anyone else. But again, just a really big thank you to obviously our panelists and the Prime team for putting their time aside and also being so transparent. We will continue to do these sessions, as we've said, and we really do appreciate you as clients, and we're continuing to work very hard to deliver you the value that you deserve. So thanks again for attending, and we look forward to speaking shortly.